There is a strip of water in the Middle East, 33 kilometers wide. You have probably never seen it. You have probably never thought about it. But right now, in 2026, that single strip of water is making your grocery bill higher, your savings worth less, and your financial future harder to predict. And almost nobody is explaining why. You did not invest in oil. You did not buy shares in a pipeline company. You have never traded a barrel of crude in your life. So why is everything costing more? Why did your food bill jump this month? Why are interest rate cuts, the ones that were supposed to help your mortgage, suddenly off the table? Most people never connect these dots. They feel the pain at the supermarket checkout, at the petrol pump, in their savings account. But they never see the chain that links a conflict in the Persian Gulf to the price of bread in Lagos, rice in Mumbai, or a flat in Birmingham. But here is what nobody tells you. Oil shocks do not just raise your fuel bill. They quietly reach into almost every corner of your financial life, including the corners you thought were safe. To understand what is happening right now, we need to go back. October 17, 1973. A car park in New Jersey. American drivers had grown up expecting cheap petrol. For 2 decades after World War II, oil was so abundant that the entire economy was built around it. Cars, suburbs, highways, heating systems. Nobody worried about where it came from. Then 11 Arab members of OPEC, the Organization of the Petroleum Exporting Countries, announced they would stop selling oil to countries supporting Israel in the Yom Kippur War. Drivers queued for hours. The U.S. Federal Reserve slashed interest rates to protect growth and accidentally made inflation worse. The price quadrupled in months. Petrol stations ran dry. Some put up red flags to signal empty pumps. What followed was a decade of stagflation. High inflation, stagnant growth, rising unemployment. All three at the same time. Economists called it impossible. The 1970s proved otherwise. And in February 2026, the same mechanism activated again, faster, more globally connected, and harder to escape than it has ever been before. So here is how it actually works today, and what it means for your money. Let us start with something most people underestimate. Oil is not just fuel. Think of oil as the invisible ingredient in almost everything you buy. Not just petrol, not just diesel. Think about the plastic packaging around your lunch, the fertilizer that grew the wheat in your bread, the truck that carried that bread from the factory to your supermarket, the refrigeration unit keeping it fresh, the plane that moved components across 3 countries before your phone was assembled. Every single one of those steps runs on oil, or on something made from oil, or on something transported using oil. When the price of oil rises sharply, every step in that chain costs more. Factories absorb higher energy bills. Logistics companies absorb higher fuel costs. Farmers absorb higher fertilizer costs. And then, because nobody runs a charity, they pass those costs to you. Here is the analogy that makes this tangible no matter where you live. Imagine a city powered by a single river. Every factory, every bakery, every hospital, every farm draws water from that river. Now someone upstream dams it. It does not matter whether you live on the east side or the west side of the city. It does not matter whether you own a boat or have never been near the water. You feel the shortage. Oil is that river for the global economy. And in 2026, someone dammed it. The numbers are stark. For every $10 increase in the price of oil, petrol prices for U.S. drivers rise by roughly 30 cents per gallon. Oil is sitting near $100 per barrel right now. That is a roughly 36% increase in fuel costs compared to where we started this year. The total hit to American consumer spending alone could reach between $50 and $150 billion for the year. But the United States is actually one of the better positioned economies. Now think about what this means in countries with weaker currencies, less domestic energy production, and households already spending 60 or 70% of their income on basic necessities. In sub-Saharan Africa, the median fiscal cost of governments shielding citizens from higher energy prices would be nearly 1% of GDP. In some countries it reaches over 2% of GDP. And 70% of sub-Saharan African governments already collect less than 15% of GDP as taxes. They cannot absorb this without cutting something else, usually education, healthcare, or infrastructure. The ripple from that one strip of water, the Strait of Hormuz, reaches every market stall, every school lunch program, and every household budget on Earth. Now here is where most financial coverage stops, and where we go deeper. When inflation rises, people expect central banks, the Federal Reserve, the Bank of England, the Reserve Bank of India, to step in and fix it. Raise interest rates, slow spending, cool the economy, bring prices down. That is the standard playbook. Every economics textbook teaches it. But an oil shock breaks that playbook entirely. Here is why. There are two kinds of inflation. The first kind is demand inflation. Too much money chasing too few goods. People are spending enthusiastically, wages are rising, the economy is running hot. Central banks fix this by raising interest rates, borrowing becomes more expensive, spending cools, prices stabilize. The second kind is supply inflation. And this is what an oil shock creates. Prices are not rising because people are spending too much. Prices are rising because it now costs more to make and move things. The supply of goods and services has effectively shrunk because the energy required to produce them has become more expensive. Raising interest rates does not fix a supply problem. Raising the cost of borrowing does not produce more oil. It does not reopen the Strait of Hormuz. It does not reduce the cost of fertilizer or diesel. What it does do, if applied during an already weakening economy, is push that weakening economy further toward recession. So the central bank is now caught in what economists call a policy trap. If they raise rates to fight inflation, they risk tipping a slowing economy into recession, with rising unemployment on top of rising prices. If they cut rates to protect growth and jobs, they allow inflation to run hot and punish every saver, every pensioner, every person trying to build real wealth. There is a name for the outcome when both things happen simultaneously: high inflation, stagnant or negative growth, rising unemployment. All three at once. It is called stagflation, and it is the most financially destructive environment a household can face. Your costs are rising. Your income is not keeping pace. Your savings are losing real value, and the government cannot easily fix any of it. This is not a theoretical warning. Every major oil shock in post-war history has been followed, in some form, in some countries, by stagflation or recession. 1973, 1979, 1990, 2008. The pattern is so consistent that leading economists have documented that 10 out of 11 U.S. post-war recessions were preceded by a sharp increase in oil prices. Right now in 2026, market data is telling us something important. The futures market is showing a 60% implied probability that the Federal Reserve will leave interest rates unchanged for the rest of this year. Rate cuts, the ones that were supposed to ease mortgage pressure and make borrowing cheaper, have effectively been taken off the table by this oil shock. In the UK, two-year gilt yields are at their worst performance since the 2022 budget crisis. Markets are now pricing in the possibility of a Bank of England rate increase, the opposite of what was expected at the start of this year. If you have a variable rate mortgage, a business loan, or any debt tied to market interest rates, this matters to your monthly outgoings right now, not in 6 months. Right now. Now we go to the level that almost no financial content reaches. The third channel through which an oil shock damages your finances, and the one most people never see coming. Most people understand the pump price channel. Oil goes up, petrol gets expensive, life costs more. Fewer people understand the interest rate channel. Rate cuts evaporate, mortgages stay expensive, borrowing stays painful. But there is a third channel. Economists call it the wealth effect, and it operates through the stock market. Here is how the mechanism works. Oil prices spike. Inflation fears spread across every market simultaneously. Investors reassess how likely central banks are to cut rates, and they conclude, not likely. With rate cuts off the table, the discount rate used to value future corporate earnings rises. Stocks, particularly growth stocks and technology companies priced on future earnings, become less attractive. Investors rotate out. Markets fall. When markets fall, something behavioral happens that the textbooks often underweight. People feel poorer, not because they have sold anything, not because they have actually lost cash, but because they opened their investment app or received their pension statement and the number is lower. And when people feel poorer on paper, they spend less in the real economy. Research from the United States estimates that every 10% decline in the stock market reduces consumer spending by roughly 1%. In an economy where 70% of all economic activity comes from consumer spending, as it does in the United States, that is not a small number. 1% of consumer spending is hundreds of billions of dollars. Now layer the effects. Oil prices hit $100 per barrel. Petrol prices rise 36%. Inflation expectations climb. Rate cuts are canceled. The stock market falls 10 to 15%. Consumer sentiment drops. People spend less. Companies earn less. Stocks fall further. Household wealth, in pensions, Osei's, 401ks, investment accounts, shrinks further. And the consumer pulls back more. Each channel amplifies the others. The oil shock does not just run through one pipe. It runs through three simultaneously, and they reinforce each other. Here is the part that matters even if you do not own a single share. Pension funds hold equities. Insurance companies hold equities. The retirement pots of people who have never touched a stock market in their lives are invested in equities through fund managers. When the market falls 15%, the real term's value of decades of retirement savings shrinks. For someone 55 years old, nearing retirement, watching a 15% decline in a pension pot can represent several years of contribution evaporating. This is not abstract. This is the hidden architecture of how an oil shock reaches deep into financial lives that have nothing to do with oil, trading, or commodity markets. The Strait of Hormuz is 33 kilometers wide. The financial damage it can cause is not contained by any border on Earth. I want to tell you about Marcus Osei. Marcus ran a small logistics company in Accra, Ghana. 4 trucks, a team of 8 drivers. A client list built over 7 years. He was exactly the kind of entrepreneur that economic growth stories are written about. In late 2021, fuel prices began rising as the world recovered from the pandemic. Marcus's accountant told him to build a 3-month emergency reserve for operating costs. Friends in the industry suggested locking in fuel contracts while prices were still moderate. Marcus did neither. Business was strong. Margins looked fine. He assumed oil would stabilize. By mid-2022, diesel in Ghana had risen more than 60% in 6 months. Ghana was simultaneously experiencing a debt crisis and a currency collapse that made imported fuel even more expensive in local cities. Marcus could not pass all the costs to customers. His delivery contracts were fixed price. He began paying fuel costs on credit cards and short-term informal loans. Within 8 months, debt repayments were consuming 35% of his revenue. He sold 2 of his 4 trucks to stay afloat. The business survived, but it was permanently smaller. And the painful postscript is this. Ghana went to the IMF for a bailout in late 2022. The austerity conditions that followed cut public sector contracts, which were Marcus's largest client base. The oil shock had cascaded into a government debt crisis, and the people least responsible for any of it paid the highest price. Marcus told a local newspaper something that stayed with me. He said, "I watched the signs for months. I just did not believe they applied to me." That sentence is why this video exists. So what do you actually do? Right now, today, whatever country you are in. Step 1. Move emergency cash out of a standard savings account this week. Inflation is rising and standard accounts in most countries are paying real negative returns right now. In the US, move to a high-yield savings account paying 4 to 5%. In the UK, check an S&I or the best easy access rate on Money Supermarket. In India, a post office savings scheme or NSC. In Nigeria, a money market fund through Cowrywise or your bank. 20 minutes. Done. Step 2. Add a small inflation protecting asset before prices embed further. Gold is available fractionally, from £25 at the Royal Mint in the UK, from 1 unit of a gold ETF in India through Grow or Zerodha, through GLD shares in the US. This is not speculation. It is insurance. Step 3. Buy your largest recurring staples now, before second-round price rises hit. Fuel, rice, pulses, tinned goods. The logistics inflation has not fully embedded in supermarket prices yet. You have a window, but it is closing. Step 4. If you hold bonds, shorten your duration. Long-dated bonds lose value when inflation expectations rise. Move toward short-term bonds, 1 to 3 years, or inflation-linked instruments. Tips in the U.S. Index-linked gilts in the U.K. IPCA plus bonds in Brazil through Tesouro Direto. Step 5. Do not panic sell equities if your investment horizon is 5 years or longer. The 1973 shock, the 1990 Gulf War shock, the 2022 Ukraine shock, markets recovered every time. Selling at a temporary low locks in losses and removes you from the recovery. The only exception, if you need that money within the next 2 years, reduce your equity exposure now. 5 steps, any country, any income level. Starting today. If this video helped you understand something the headlines are not explaining, subscribe to Finance with Prahlad. Every week we take the biggest economic forces shaping this world and translate them into something you can actually act on, wherever you live, whatever you earn. Next week, we are going to show you exactly why central banks are terrified right now, and what their fear means for your mortgage, your savings, and your job. You do not want to miss that one. Finance with Prahlad. This is how you build real financial intelligence.